Okay, for chapter 7, we will finish it today. So if you remember, when we want to recognize, record our accounts receivable, depends on sales revenue, right? So how we recognize, record sales revenue, then how we record accounts receivables. So when we record the amount, based on fixed amount purchase price, also we have to consider variable consideration 变动对价. So we've done these three already. So trade discount, quantity discount, you have to consider that. For cash discount, we have gross method, net method. Okay? For cash discount, we allow you to choose gross method. Why is that? Because the time is too short. So we expect accounts receivable will be disappear pretty soon, because we expect to get the money from customers within 1 to 3 months. So the time is too short. So even though you choose gross method, they won't affect our financial statements a lot. So that's why we accept that. But for sales return allowances, remember, still we have to go back to our net methods, because net methods is the theoretically correct. So we have to record how much money we expect to receive from customers, right? So that's why we choose, you should only use net methods. Okay, so we've done 3 already. Last one, time value of money. Of course, that's quite important, because today's money is not the same as future's money, right? Okay, so have you heard the big trade, big transaction these 2 days? Did you play baseball? No? You don't know that? If you play baseball, I didn't, but my brother did, so I heard some news from him. They have a big contract these 2 days. The big contract is $700 million US. $700 million US. So if you think $700 million is quite big, right? But they have the condition. So what's that? The player accept to defer the payments. So for the 10 years, he will just get 20 million each year. So in other words, $680 million for model money he will get is after 10 years. So you know the value is quite different. So how much money actually the value have? Amazing. I know you knew it, right? So the 700 million contract, actually the present value is not 700 million. Why is that? Because you have to consider time value of money. So it's quite basic and important, you know. But in accounting, here I want to tell you, accounting, for 2 reasons, we won't consider that factor, okay? Even though it's quite basic and important. First is when the amount is not material. So the amount is not that too big. So when the amount is not that too big, accounting will ignore time value of the money. Why is that? Because you want to get 100% correct, you have to spend much time to do it. So accounting usually we based on cost-benefit trade-off. So cost-benefit, we will consider whether it's worth to do it. Cost, we spend much time. Benefit, $1, $2. So the benefit is not enough for us to spend much time to do that. Okay, so that's why accounting, when the amount is not that big, we ignore time value of money. So that's the first situation, when the amount is not that big. Second situation is when we talk about short term, we will ignore time value of money. Still the same reason. Short term, you know, accounting, we have so many jobs to do. So short term, we think is not affect too much. Short term, 1 year, so it's okay. So for that second situation, we will ignore time value of money. So did you find out when we talk about inventory, when we talk about accounts receivables, have we considered time value of money? No, we didn't. So when we talk about long term, like what? Chapter 14, bonds payable. Have we considered time value of money? Yes, because it's long term and also the amount is big. Okay? So some cases we ignore that time value of money because the amount is too not big and it's short term. So I just want to tell that. Another issue is valuation. So what is the issue I want to talk about? At the beginning, we've mentioned we have a 3 point of time in this chapter, right? So 3 point of time. We finish the first point of time, transaction, when we sell the product to customers, then how we recognize, record the transaction. Right now, we talk about valuation, means on the last day when we are going to prepare financial statements, so which amount we should report on our balance sheet. So right now we are here, okay, valuation. But this part totally the same as your first year. So that's why we won't spend much time on here. So did you find out? Review of your first year. For this point of time, totally the same. So what should we do? Remember? We use which accounting method to record the part maybe we cannot get back in the future. So we use allowance method by default, right? So allowance method by default is what? Even though it haven't happened yet, but we expect what's going on in the future. So it's not true, but we will consider the risk, the part maybe we cannot get back, right? Allowance method. Then for the amount, so what's the journal entry we use? Debit, payday expense, right? Credit, allowance for doubtful account. So at the end of each period, we use journal entry, debit, payday expense, credit, allowance for doubtful account to record the part, the amount, maybe we cannot get back. So how about the amount? We know the journal entry. So what's the amount we are going to use? Which method we use to estimate the amount? Debit, payday expense, right? Credit, allowance for doubtful account. Then for the amount, which method we use? We have two methods, right? What are these two methods? Percentage of total receivables or aging the accounts receivables. So these two methods, what's the difference? The difference is, second method, we consider the age, right? So we are based on the age to estimate the pay days. Okay, any questions? So totally the same as first year. But why we do that? You know, it's estimate, so it's not really true. Why we spend much time trying to estimate the pay days, trying to estimate the amount maybe we cannot collect back in the future? Why is that? What's the reason? Because we think payday expense, the part maybe we cannot get back in the future, is no more risk. Why is no more risk? Do you think when you lend the money to someone else, always 100% you will get the money back? No, it's not. You have to prepare, they won't pay the money back. So the normal situation is when you lend the money to someone else, if you lend the money to 2 or 3 people, so for your classmates, you have to prepare yourself. You won't get the money back. So that's why it's normal risk. It's not abnormal. It's normal, quite common situation. You cannot get the money back in the future. Okay? Since it's normal situation, then we have to consider it each time. Okay? Leah, what's the question you have? No? Okay? Then also, why we have to estimate the pay date at the end of each period. Don't forget. For assets, you have two very important issues for assets. What's that? Every kind of assets, we've mentioned a lot. Any kind of assets, always we consider two important issues. Any kind of asset. What's the first one? Whether if I sell the asset, whether it's true sale or not. So like your inventory, when we sell the inventory to customers, we have to make sure it's true sale or not. When we sell accounts receivable, later we will talk about that. Still, we have to consider it's true sale or not. When we talk about chapter 10 or 11 PP, still we have to consider the sale is true sale or not. So any kind of assets, always we will consider is true sales or not. So how to determine is true sales or not? Whether the control is transferred or not. Whether the risk and reward is transferred or not. Okay, so chapter 8, inventory, we talk about that. Later, we will still talk about it when we mention accounts receivable. So whether it's true sale or not, you have to see, consider transfer or not, risk and reward transfer or not. Okay? For any kind of assets, second major issue, always we talk about that, is what? Whether the amount, the dollars you report meet our definition of assets. Okay? So the second issue for any kind of assets, whether the amount reported meet the definition of assets. Okay? So did you find out for inventory, what should we do? What do we do for inventory? We use which method? To make sure any amount we report on balance sheet meet the definition of assets. Which method we use? Forgot it already? You have a quiz from last week. For inventory, which method we use? LCNRV. Right? Right? LCNRV, right? So use LCNRV, we make sure we report the amount provide future economic benefit, right? So if your cost lower than NRV, your cost higher than NRV, for the different we report loss, right? Okay? If you forgot, it's okay, we have final exam. So we will compare cost vs NRV, right? So when cost higher than NRV, we will report what? Loss, right? Why? Loss, this part, no future benefit. Okay? Totally the same as accounts receivable. Why accounts receivable? Even though pay day expense haven't happened yet, why we use allowance method 背离法. Why we use these two methods, try to record our pay day expense. Because pay day expense, we don't expect we will receive from future, right? So this part, we think no future economic benefit. So that's why we record it now. Okay? So second one, for receivables. Then how we use it? We use pay day expense. Because the pay day expense still no future economic benefit, so we record it now. Okay? When we talk about CPP, still the same concept. When we talk about long-term notes receivable, long-term bonds receivable, when we talk about intangible assets, when we talk about other investments, still the same. Using different methods, try to meet the definition of assets. So that's why you should understand, no matter we talk about what kind of assets, we always focus on these two issues. Okay? So inventory, we use LCNRV. Receivables, we use allowance method to estimate pay day expense. Okay? For PPE Chapter 11, we will use another method to estimate PPE, the part, no future economic benefit. Okay? So that's the reason why we do that for our receivables. No questions? So here I told you why we do that. Because we want to meet the definition of assets. Okay? Because for that part, overstated, for that part, no future economic benefit, 高估. So for this part, no future economic benefit, we don't want to record it as assets. Okay? I mentioned that just want you to understand, even though intermediate accounting, different chapter told you different topic, different assets, but actually we have the consistent logic for any assets. Okay, so if you know the logic, it's easier for you to understand why we do that for different assets. Okay, so how to do that? Please go back to your first year. So how to record pay day expense? We won't mention that again. Then finish accounts receivable. How about notes receivable? Totally the same. Notes receivable, the difference is written promise, right? And for notes receivables, usually how we have notes receivable. Most reason we have notes receivable is from lending transactions. So we lend the money to someone else, we have notes receivables. Okay, so that's a major reason. Of course, we have other reasons we have notes receivables, but the major reason is you lend the money to someone else. Okay, so most of the reasons is not because of revenues. Why we mention that? Because before we talk about accounts receivable. For accounts receivable, how we record accounts receivable, you have to consider how we record revenues, right? Because revenues mean you have accounts receivables. Okay? Because of sales revenues mean you have accounts receivables. So that's why when we talk about accounts receivables, you have to think about sales revenue, how we record that revenue. Then they affect how you record accounts receivable. But here, notes receivable usually from lending transactions. So do you need to think about revenues? You don't need to, okay? So that's a point I want to mention. So for notes receivables, you don't need to think about revenues. So that's why I here told you, now related to recognition of revenues. So you don't need to care about how we recognize revenues, okay? Because most of reason from lendings. So that's why we will just think we lend the money to someone else, then how to record it. Okay? So how to record it? Did you find out? For short term, notes receivable, still we use face value. We don't consider about time value of money. Why is that? Because it's short term. So that's why we use face value. But when we talk about long term, we will consider time value of money. Okay? So this is accounting because we want to save our time. So short term we ignore time value of money for short term. Okay? And when we consider time value of money, I think it's familiar with you guys, right? Chapter 14, issue at the face value, issue at the premium, issue at the discount. So we don't talk about that again. Also, for our notes, remember we have zero interest bearing note, 无付息票据, interest bearing note, 付息票据. But remember, what's the difference? Zero interest bearing note means what? Our contractual interest rate is 0. So on your note, your stated rate, contractual interest rate is 0. Interest bearing note, your stated rate, contractual interest rate is maybe 5%, 10%, any percentage. Okay? But even though we have stated rate 0%, do you still have interest? Yes. So where have the interest? We include the interest on which part? We have a two interest. Cost of borrowing, 借贷成本. 借贷成本, cost of borrowing, we have two parts. First is what? Stated rate, contractual interest rate, right? What's the second part? Sorry? Yeah. The total amount is on which part? Discount premium. So amortization, we allocate part of numbers to each period. So you're right, amortization is discount amortization, premium amortization. So amortization is allocate discount premium into each period. So still this is your interest. So we have two. So what's the first? Steady rate, right? Contractual interest rate. If you still remember, contractual rate plus discount or premium. This is your second cost of borrowing. Right? Remember? So we have one contractual interest rate we paid each period. We have second cost of borrowing is premium or discount. So that's why we do discount amortization. We do premium amortization, trying to get our second interest for each period. Okay? So when your note is what? When your note is zero interest bearing note, you don't have steady rate. So means what? All of your interest, including on discount premium, right? When the first part is zero, so what does it mean? All the interest, including on second part. Okay? So that's right. For your zero interest bearing note, your interest all include on discount or premium. Okay? Any questions? Maybe for your final exam, we have a whole semester's test to let you review the contents again. Just kidding. Okay, just kidding, don't worry. So for valuation, at the end of each period, when we are going to prepare financial statements, short term, remember, short term, long term. For accounting, short term, we will ignore time value of money. Since we ignore time value of money, so we will use a simple method to achieve our purpose. So notes receivables for short term, totally the same as your accounts receivable. How we estimate the part without future economic benefit because it's short term. So we use the simple way. So totally the same as your accounts receivable. Okay? So we use allowance method to estimate the pay days. But for long terms, it is different. Why? Because we have to consider time value of the money. Okay? So we will have different methods to consider the part without future economic benefit because we consider time value of the money. So we use different methods, but still we want to achieve the same purpose. For assets without future economic benefits, we don't want to record it as assets. Okay? But because short term, long term, we have different methods. So long term is for chapter 17. So did you find out the word impairments, 减损? So impairment, 减损, actually the same meaning. We want to talk about the part without future economic benefit. Okay, we will mention impairment again in your chapter 11. Chapter 11 next semester. Maybe you will, maybe you will not. Okay. No problem. If you don't have any questions, so for the second point of time valuation, the amount we are going to report on balance sheet depends on short term or long term. Short term, we will use allowance method to estimate paid day expense. Okay. For long term, we will use different methods, but we haven't mentioned yet. Okay, then let's talk about the third point of time. So what's the third point of time? In case you forgot again. We talk about right now here when we want to remove our accounts receivable from our accounting books. When we want to sell our accounts receivables, could you sell accounts receivables to someone else? Yes, of course. Any kind of assets, you could sell it. Okay? So when we want to sell it, if you remember, sales, when we talk about sales of assets, what's the key issue we want to know? Assets. Remember, we have two major issues for assets. What's that? It's 20 minutes ago. Two major issues. What's that? Okay, that's it for today. See you. Not here anymore. Sorry. First is what? True sales. Second is whether the assets, the amount meet the definition of assets, right? Okay. So for our payday expense, for our impairments, that's our second major issue, right? The amount whether meet the definition of assets. So right now, when we talk about sales, then first idea you should have is what? Is true sale or not? So right now we talk about again is true sales or not. So we talk about when our receivables is the recognition of receivables. So we won't have the receivables on our accounting books. Okay. So what kind of situations we will remove receivables from our accounting books? So far you've learned from your first year. When you don't have any values for receivables, right? Since the receivables don't have any values, it's not necessary to report it on your accounting books. So what kind of situations the receivables don't have the value anymore? Depends on you are lucky or you are unlucky. So you are lucky means what? You got the cash from customers. So if you are lucky, you got the cash from customers. Okay? So the receivables no value anymore. Why is that? Because you got the cash from customers. So you got the cash. When you are unlucky, still the same, receivables without any values. So what kind of situation you are unlucky? Customer can't pay the money back anymore. You gotta pay the expense. Okay? So you cannot get the money back from customers anymore. So you are unlucky. In that case, receivables without any values anymore. Okay? So in that situation, what should we do? Write off your pay days. How to write off your pay days? What's a debit? What's a credit to write off your pay days? Because here, unlucky, we mean actual loss happen. Okay? Actual loss happen. Allowance method 背离法 how to write off the bad days. Debit allowance for doubtful account. Credit accounts receivables. So did you find out? Your accounts receivable will be removed from your accounting books since they don't have any values. Why? Because you really cannot get the money back from customers. If you're lucky, you got the cash. So what does that mean? You got the cash. Also, you don't have accounts receivables. Okay? So that's from your first year. We talk about you are lucky or you are unlucky. Okay? Second case is what? It's not because of customers. It's because you want to sell your receivables to others. So second case, when we want to sell receivables to other companies, we talk about the second case. Then we mention is receivable financing. So for receivable financing means what? We give receivables to other companies. Why? Because we need the money. We want to get the money, okay? So how you could do that? Sell it. So the first choice you could make is sell your receivables to bank. When you sell it, you can get the money you need, okay? Second choice you can make is what? You use your receivables as collaterals. So you just want to borrow money from the bank and use your receivables as collateral. Okay? So there's a two ways you can get the money. Jia-Chi. Finish these two, finish chapter 7. Okay, so we talk about sales first. So when we talk about sales, remember I just mentioned sales, any kind of assets, the first question you have to ask is what? True sale or not? Okay, so true sale or not? Before we talk about it, true sale or not? Remember, for your first year, we sell the receivables to whom? To factor, right? So like your bank, financial companies, we sell receivables to bank, financial company. Why? Because that's part of their business. They are good enough to collect the money from others. So they just want to do what they're good at, right? So sell the receivables to factors, but nothing for free. You sell receivables to bank. They have to do the job for you. So what kind of job they have to do? Collect the money from customers. So nothing for free. So you have to pay commission fee, 佣金 to the bank, the factor. Okay? Then why you want to do that? Why you want to sell receivables to factor, to the bank? Remember, first reason is what? You don't want to do the dirty job. So what is the dirty job? Collect the money from customers. It's quite hard to do that. Like what? If you lend the money to someone else, could you ask them pay the money back? Well, or you are waiting there. Someday they will pay the money back. How about you, Leah? You will ask them? Okay. for me, sometimes I'm afraid. Not afraid, I'm too shy to ask they pay the money back. So sometimes I wait there, and every day I think when they will pay the money back. So it's better not to lend the money to someone else. So try to collect the money back is a dirty job. If you don't want to do it like me, then you will decide, let bank do the job for you guys. Okay? So you will sell it. So that's a first major reason you don't want to do that. Second major reason why we sell receivables to the bank, because we need the money. Maybe you will say, okay, I need the money. You just borrow money from bank. That's it. So second reason is it's quite hard for you to borrow money from the bank. That's why you decide to sell it. Okay? Then why it's quite hard for you to borrow money from the bank? First reason is you don't want to do dirty job. Okay, second reason for 3 and 4 is what? It's hard for your company to borrow money anymore. Why is quite hard for your company to borrow money? Because your liability is too high already. You have so many liabilities already. So other companies are not willing to lend you money, right? Because higher liability means what? Higher risk, cannot pay the money back. Hard to borrow money because your liability is too high. High liability means high risk. Okay? So because of that, other company is not willing to lend you money. So if you still want to lend the money, you still want to borrow money from other company, how? Only you pay higher interest expense, right? So higher liability, higher risk. So when your company is high risk, how you still can borrow money from other company? You have to pay them higher interest. So they will cost you a lot of money. You don't want to do that. Okay? So because you maybe have to pay high interest expense, so that's why you decide, okay, maybe we don't do that. We just sell our receivables, try to find the money using other way. Okay? Second is what? Your creditors. We have the contract with the creditors. So the creditors know when you have a higher liability, higher risk, creditor want to protect themselves. So usually for the contract, they will what? They will exceed the limit of liabilities you have. So your creditors don't allow you to borrow money anymore, okay? Because they will violate the contract. And the contract will mention what the liabilities you could have. So your creditors don't allow you to do that. Okay? So maybe you don't want to do a dirty job. Maybe you cannot do that because you have too much liability already. Creditors don't allow you to borrow money to have more liabilities. Okay? So because of that, that's why today, right now, we talk about your company decide want to sell their receivables, okay? Because they cannot borrow money from others or they don't want to do the dirty job. So when we talk about sales or receivables, I just mentioned the first major issue, accounting, we always care about is what? True sale or not. So that's why we have to consider your sales is true sale or not. So we have two situations, sales without guarantee and sales with guarantee. These two cases. Okay? So what does it mean? Sales without guarantee means without any promise. When we sell the accounts receivable to factors, we don't offer any promise. So without guarantee means without promise. With guarantee means what? With promise. Okay? Before we talk about that, let you guess which one is true sale, which one is not true sale. After your guess, we take a break. Without guarantee, no promises. So is true sale or not? It's true sales. Yeah. Okay, take a break.